So while you always hear the term asset rich, cash poor from a real estate investor, well, you kind of want to have some cash on hand. God forbid something happens, you need a little bit of cash. What are you going to do? People say all the time that folks in my generation, meaning we got in the real estate game after 2008, they say all the time that folks in my generation, we think that real estate values only go up. We don't know what true pain is. And since we haven't lived through the recession, the great real estate crisis of 2008, we don't know how to manage risk. And I'll tell you, that's not true. I've done a ton of studying on managing risk in real estate, and I think we have our portfolio set up pretty well. In this episode, I'm going to talk about a couple things that we've done and a couple things that maybe you can do to manage risk. So first things first, there are levers in real estate that are in your control, and there are levers in real estate that are outside of your control. Outside of your control levers include, hey, when are the supplies going to show up on site? How much are they going to cost when it's finally time to lock in the payment that we're having to pay for this construction? What are interest rates going to be when we need to refinance? What are interest rates going to be for the buyer who's going to buy my asset 5 years from now, like I have projected? What's going to happen to rents? You can control that a little bit. What's going to happen to my expenses? You can control that a little bit. And what is somebody else going to pay for my asset? That's something that none of us can control. What somebody else is willing to pay in relation to our profitability. What is somebody else willing to pay for our assets? Those are all things that are outside of my control. So what I do in my portfolio is I focus on minimizing the things outside of my control that I need to go right. I can't control interest rates, I can't control cap rates, and I can't control what somebody else is willing to pay for my asset. How can I minimize the effect of those while maximizing the things that I can control, like my operations, the deal that I buy, how we structure the deal, and so on. So I'm going to talk about a couple things that we're doing inside of our portfolio to minimize risk. And I'll tell you that this is a little bit easier said than done. We have gotten very, very lucky in the self-storage market. We've got some tremendous tailwinds. Rent growth is up 25% year over year in my portfolio based on last year. And we have a really, really good business behind us. And we have a machine built to find really good deals. So this is not really something that I would say is achievable for everybody in every asset class, but there are some investors that do it really, really well. This is also something that you should think about maybe if you're considering investing in a deal with somebody else, with a sponsor. Hey, what are they assuming? What assumptions are they making, and how much of that is in their control and how much of it isn't? What are they projecting revenue to go up, and what are they projecting it to be? We looked at a memo a couple hours ago from a competitor of ours who's buying massive amounts of storage, super aggressive. They sent out to OM, they're buying an asset for $45 million. They're projecting 25% year one revenue growth, 17% growth year two. They're projecting a 29% expense ratio, whereas we underwrite a 35 or 40% expense ratio in all the deals that we do. And they have full-time managers on site while we don't. I think it's going to be very hard for them to hit those projections, but alas, who am I to judge? They're also levering it up quite a bit. So some things we're doing, we're buying in-place cash flow, number one. I mean, there's nothing wrong with development. Developers make really, really good money. People who buy extreme value add, you can add tons of value. I'm not poo-pooing on that at all. But at our point in the cycle, where our net worths are what we have to lose, I'd rather not risk a speculative investment of adding a ton of value to a property. That's risk, right? So we're buying in-place cash flow. We need our debt yield, which is net operating income divided by the amount of debt we have. How much net operating income is the debt generating? We have a debt yield year one over 9% on every single deal that we buy. 9% meaning we can take a 7% interest rate with principal and interest payments on a 25-year AM, and we're still going to break even. We're not going to actually lose money on a monthly basis. So we're not speculating on year three pro forma cash flows to make our money, because that's how, in my opinion, you can go belly up. And if you look at the deals that we bought, our portfolio-wide debt yield is over 15%, meaning interest rates on all of my self-storage could go up to about 13%. Interest rates 13%, principal and interest, and we're about break even on cash flow. I'm proud of that. Another thing inside of my private equity company, this is underrated. Inside of my real estate private equity company, we charge market fees. We're not on this low cost, low fee structure so that we can get more of the promote, and we're taking a ton of risk from our perspective and got all of our money tied up in the deal so that if we sell it or when we sell it, we can make a bunch of money. We charge fees. We charge an asset management fee every year. We charge a management fee to manage the actual building, equivalent to about 8% of the portfolio revenue. These little fees allow us to not do anything and our team can still eat. We can still make payroll even if we're not doing deals. That allows me and my team to weather a downturn. If we can't do deals, if we're tight on cash, whatever it might be, we have income coming in to support us, our families, and our team, and keep our team intact.
The Nick Huber Show is sponsored by Juniper Square. And if you raise money for your real estate deals from outside investors, Juniper Square can help you manage the entire process. No more emails, spreadsheets, or scrambling to complete a raise a few days before closing. Investors can commit to your deal, fund your deal, and you can share updates, documents, and even send distributions right from the software. It's as efficient as it gets. I use Juniper Square to manage all of my deals, and it's an incredibly easy way to invite investors to the deal room, raise the money, and stay organized with deal docs and communication. And the best part, it makes me look insanely professional in the eyes of all of my investors. Visit junipersquare.com to learn more.
I just wanted to let you know that we have a paid real estate community with over 500 members. Not many people know about this. It's on Facebook. It's an inside look into my business and many other business. It's skewed towards self-storage, but there's also a lot of other commercial real estate investors in the group. We're pinging ideas off of each other. It's just where I share a lot more intimate details about my business than what I share on Twitter or on this podcast. So if you're interested in this and you want to meet other people, there's been people investing in each other's deals on there. There's been people share deals that other people bought. It's a place where a lot of cool stuff is happening. If you're interested in this, visit sweatystartup.com/REC, as in real estate community. sweatystartup.com/REC. There's a free trial as well. You can check it out for a week for $1.